in your life, or you own a business and you're saying, hey, I want to buy this property, I want to buy this apartment building, I want to buy this duplex, I want to sell my first house, I want to buy my kids, you know, a car or something like that, come talk to me. You know, that's what I'm here for. Tax strategy and business consulting. Plan your work and work your plan. Tax return preparation and compliance. That's the January through April, what most people think, but I'm more than that. My bills, you know, come all year round. I work all year round. And I like what I do. So representation and audit system. Uh-oh, I got in trouble. I got a letter from the IRS. Yep. So tax collection issues, bankruptcy, things like that. My website is there. It's also on your documents. And that has a lot of tools on there and information about me. So I have 2 different websites in addition to the myEcon website. So you can just kind of look at those and get more information and spread the word. So this is the overview of where I'm going. I told you I'll be brief on the slides. Just tax planning, Tax Cuts and Jobs Act, and then questions and answers. And then we'll get into the workshop. So, tax deadline is coming up. This is the overview for the federal 2018 tax return. Who here is not a resident of Texas? What's your state?
Georgia.
Georgia. Okay. So you're going to have an additional tax return to file, a state tax return. Yeah. Here in the great state of Texas, we have no state income tax returns.
I'm thinking about moving.
So there are 9 states with no state income tax returns. So if you're active duty Army.
No, I'm retired.
Okay. So Fort Campbell, Kentucky, not Kentucky, Tennessee, no state income tax. Texas, Arizona, Nevada,
Florida.
And then some of those are community. I think it's 9 community property states. So just kind of be careful where you choose your residency and your permanent address. But Texas is very tax friendly, so I, you know, plan to be a Texas resident. So regardless of the shutdown, the IRS wants their money. They don't care about holding on to your money. You guys have already fixed your W-4s. So y'all are good to go. Y'all don't care if the government shut down because they're not holding on to too much of your money. So you're already ahead of the game. But January 28th is when they start processing returns. If you filed early, then you're not necessarily going to get your money any earlier. You just got in line earlier. Depending on what tax credits you get, Chauncey mentioned the earned income tax credit, you're not going to get a refund until mid-February anyway. Those are the ones they hold because of a lot of fraud. So January 31st, that's already occurred, so you should have your W-2. If you don't have your W-2 from your employer, you need to contact them and they can provide it to you either hard copy or in the mail. 1099s, the deadline to file those if you pay out people information. So if you have, you know, independent contractors under you, or if you made more than $600 from myEcon, they should send you a 1099 by the 15th of February. If not, contact them, and then if you don't get in contact, they're out of business, and that you haven't gotten your documents, contact the IRS. April 15th is the normal filing deadline. That is the deadline to file. If you owe money, that is the deadline to pay money. If you file an extension, you are filing an extension to file your tax return, not an extension to pay money. So if you file an extension, you're still owe money as of April 15th, but you can file a return of October 15th. So those are 2 different penalties that you could possibly face if you don't know the deadline. So that's why I stress this. I don't want you wasting your money on penalties.
I was just going to say that if you don't owe anything, but they owe you, and you delayed on your filing, there's no penalty. You just penalize yourself because you owe this money.
Exactly. And you can go back 3 years for a refund.
You can pay on the 15th to file in October.
Exactly. So if you know you usually have a balance due, if you play that game, you're like, okay, I don't care if I'm getting a big refund, I don't want to break even, or I don't want to pay, I probably have to pay $200. If you're not making quarterly estimated payments or having money come out of other pensions or other income sources, you just want to make sure whatever your balance due, you're paying it enough. And then once you file, once you figure out all your receipts and your deductions and get everything figured out and get to your bottom line, what's taxable, then you have longer to file. But if you're doing a refund, it's no penalty. Or if you're active duty, your clients are active duty military, and they're overseas and they get a natural extension also. So 2018 tax return. So we're going to talk a little bit about the Schedule A, which is itemized deductions. But the IRS, they're trying to simplify everything. They're trying to simplify the tax forms. They confused everybody this year. But they're saying, okay, we really don't want to process a lot of Schedule A's and audit a lot of Schedule A's, so we're gonna up the standard deduction. So if you are single or married filing separately, it's $12,000. If you are married or a qualified widow or widower, it's $24,000. So these are things like your medical expenses out of pocket, your taxes, personal property taxes, your charitable donations, your miscellaneous business expenses, your losses. So those are things to say, okay, if they don't add up to more than $24,000 and you're married, just take the standard deduction, don't worry about that. So every year it could change, it could swing if you buy a new house or, you know, if you had braces for your kids or something. It's something you want to look at every year to see, okay, what's beneficial for you. Don't let anyone automatically say, oh, I'm just going to give you the standard deduction. If you know you have big out-of-pocket expenses, you know, you got to speak up. Head of household, $18,000, so that's if you have a qualifying child, qualifying relative living with you. And then if you're over age 65 or blind, then you get an additional amount to your standard deduction. So these numbers are for 2018. They are indexed for inflation, so they will change every year. You don't have to memorize them, but just because they changed the law, we got whole even numbers this year. Yes, ma'am.
Okay, so what's that additional if over age 65?
So if you're over age 65, it's like $1,300 that you get in your additional standard deduction.
So it'd be 13.
Plus the whichever your filing status. So if it's $12,000, if you're single, then it's 13, like 200 or 13,300, I think, is your standard deduction. And then if you're blind, then you would just add. So it's each occurrence. So if you're blind, then you add another 1,300. Like, the numbers change a little differently depending on your filing status. So I didn't want to put too many numbers on the slide,
Right.
but it just depends.
And somebody gonna ask a crazy question like this here. How much over 65? So I say, if you turn 65 today, tomorrow you're over 65.
Right, so your age, your marital status, whether you have a birth or a death birth, if they're here by December 31st, that's what you would put on to go by your tax return. So if you were divorced and your divorce was finalized on December 15th, I have to look at the rules, but you're probably single. But if you got married on December 15th, then you're married for the whole year.
So if this is a birthday year and you turn 65 this year, you have to claim it next year. You can't claim it.
So if you turn 65 in 2018, then you get the extra. Because this is our 2018 tax return, right?
Got it.
2018.
Okay.
So personal exemption deduction is currently suspended through 2025. So this is something they didn't automatically take away. You're like, Rosalind, what are you talking about? That's if you're, before you always got the standard, well, you always had the option to do standard, but then there would be an extra $3,550 or whatever for everyone else you're claiming. So people would claim 5 kids. They're like, oh, I'm claiming all these dependents. That went away. There's other ways you can pick it up in credits, but that amount went away. Well, it's suspended, so it could permanently go away. They could bring it back. Who knows? The laws are always going to be changing. I will always be employed and have value to society. So it's just staying aware on top of that. The penalty for not having health insurance is $0 for 2018. So that's the Affordable Care Act. Before they were penalizing people the shared responsibility payment. So that they just changed that to 0. Of course, that can change. The child tax credit. So it used to be $1,000 per child, per qualifying child, and that doubled, so that's $2,000. So those are my little 1-year-old, 3-year-old, $2,000 each. But part of that may or may not be refundable, depending on your total tax liability. Credit for other dependents. This is what I was talking about. So not necessarily if you have like adult children that are like 26 years old and over, that live with you, that live off of you and don't have their own income, or you're taking care of an elderly parent, because some people are in that sandwich generation, right? Then that's the $500 credit. So you don't get the $3,000 or whatever. And typically a credit is going to be better than a deduction, because a credit is a dollar for dollar reduction of your tax liability. If it's refundable, it's dollar for dollar in your pocket.
No.
Deduction is just, okay, if I take off $2,000 is $2,000 times whatever your tax bracket is, the actual value for you. Tuitions.
That credit for other dependents, you said something about children over or up to 26, but what about grandchildren?
So if you're claiming them on your return, then yes, that's the other dependent. And there's different tests, just like there was. That aren't married and they're trying to claim the child, and you know there's no divorce decree that says this person can claim it. So it's a lot of rules, and it's, you know, tiebreaker tests and a lot of things like that. Okay, so back to my website. This here I like to put up if you want to do any more calculators and tools and anything. There's blogs, there's articles, there's a lot of credible information about taxes. So you would go to that top bar where it says financial calculators. And these are just 3 that I thought were important. But that 1040 tax calculator, so if you're like Chauncey, you don't have all your deductions together, you're like, hey, let me see if I have a, you know, $60,000 loss, or if I have a $5,000 profit. What does that do to my tax return? So you can go in and you can put in all the information and say and play with it. Similar to the myEcon tools, but it's just taxes. So if you say, okay, if I claim this child and I get the EIC, or if I get the child tax credit, or you know, if I had a loss, if I sold my house or something like that, then you get that information. And you can play with things and play with the EIC calculator, estate tax planning calculator, if you had a death in that year or something like that. So there's a lot of different tools that I think are helpful for people to have. Like I said, I don't just do this during tax season. I really try to add value to people's lives all year round when they have those major life events. And these are the major life events that we're talking about. So birth or adoption of a child, marriage or divorce, death of a loved one, you're buying, you're selling, or renting out real estate, your college-age children once they become 18, or you know, once they get out of college and become 26 and they're out on their own, moving or relocations, employment changes, promotions, you're in a different pay grade, you're different, you become not an employee but an independent contractor, you start driving Uber, you've never driven Uber before, you're like, okay, what do I do? Your retirement, are you planning for retirement, you're self-employed, or you have a partnership with someone else. So those are what I consider life-changing events where you really want to talk to a tax professional, a tax preparer, and say, or even at your tax thing, you say, okay, well, you know, I'm preparing your taxes for this year, and say, okay, well, you know, I think that, you know, my wife is going to retire and we don't know what that's going to look like, or, you know, I have a kid going off to college, and you know, does it make sense for her to claim her on her own taxes, or should we continue to claim her? You know, and that's a whole different conversation as far as how that impacts her financial aid. So those are valuable conversations where a lot of people will say, well, I want to do it on TurboTax. Like, okay, but TurboTax is not going to ask you all those questions. You don't have a person that really can sit down and prepare you based on some of the things. Like the TurboTax and the software is just garbage in, garbage out. You have to know how to answer the questions. And so much has changed this year, so their software is just like, okay, our mission is to get you a tax return. Our mission isn't really to care about your long-term financial planning, your legacy for your children or your elderly parents, or you know what's going to happen with them. So time and money saving tips is get organized, use your tools. When Dexter showed me the cash flow strategist, I immediately was like, hey, I'm in. You know, because I was like, all my clients need this. Like, I'm in, you know, sign me up. Cash flow manager, yeah, and the receipts and everything. So it's just like, hey, you send me that, your clients have that, they're going to discount. Like, because that's value. Because they care about their own financial situation to do the work, to get to know what they can deduct, to know the laws, and to help others do the same. So, yep, automatic discount. Avoid penalties and no key dates. That was the first slide that we talked about. If you have employees, you need to file those W-2s. If your kids are your employees, you need to file those W-2s. If you have independent contractors, subcontractors, you're paying them more than $600, you need to file a 1099 for them. And that's good. Even if it's less than that, give them the 1099 because that's proof of income that they can use if they get audited. Because people may think, oh, well, you only paid your housekeeper $200 cash. You know, give her 1099, you know. Give her 1099. She has a business. She's self-employed. She needs that for her his or her, taxes and credits, give them a 1099. It's not gonna hurt. But if you're an employer and you're not sending 1099s, you can get penalized. And you're like, oh, well, I didn't know. Someone just told me to pay my kids as employees. So it's knowledge. It's not just having that, oh, I heard. It's like, okay, but this is why, and this is what else you need to do, because there's a responsibility in having your own business. It's a responsibility in having a job, but more responsibility as a taxpayer. Lower your taxable income, maximize deductions and your contributions. So the timing of, if you have a Schedule A year, like last year, say your mortgage wasn't really paying off, or you gained a lot of money. So whatever money you were going to give to a charitable organization in January, February, hey, write that check in December. Give those organizations that money, and then next year take the standard deduction. So there's a lot of shifting that you can do even there with your contributions to get the most bang for your buck. Because generally you want to take your deduction sooner rather than later, right? Because that's just waiting on your money. Okay, so we talked about this briefly. This was the bill, the Tax Cuts and Jobs Act, that was passed in December 2017. And a lot of people in the tax code industry, especially the unlicensed folks, are still trying to digest this. Taxpayers are trying to digest this. Corporations are trying to digest this legislation. The IRS is choking on it. They can't digest it fast enough. They had to change all the forms. And I went to an IRS training in San Diego, tax deductible trip, right? And networked with other tax professionals and learned from the IRS themselves and the revenue agents. So it was an interesting experience to hear from their side, because they're like, hey, we don't make the laws. We get the flack, everyone hates the IRS. But Congress did this. Congress did this. The people that, you guys elected did this, gave it to the IRS. The IRS has to process it, and then the rest of the world has to process it. So a lot of tax preparers are retiring. Tax code changes historically every 32 years. So this is a major overhaul. So just because you've been doing it one way before does not mean that you're going to get the same results. So if you always had to pay, oh, I know I got to pay $200, and oh, I know I'm getting $2,000 back, that's not the same. And then once you do your tax return for this year, update your W-4 again if you still have a if you're still doing payroll, and if you're a W-4 employee, update it again. If it's not what you want, update it again. If something changes, update it so that you don't have a balance due, so that you're not having penalties, or you're not getting a big refund when you could have been paying down on that debt at 17% or 12% on your credit cards. So it's income shifting. It's just taking advantage of the knowledge to apply it to make it work for you to get your goals. So as a business owner, these are the two major, it's 3 pieces of legislation that from the actual Internal Revenue Code that I wanted to highlight, just so you guys can kind of have an awareness about. Is the Section 199A deduction. So does anyone have rental property, like that they're renting out? So this qualifies under there. So it's a 20% deduction if you're eligible. So certain things like that. So we talked about the corporations got a 14%. Tax cut. They went from 35 to 21. So that was for corporations. So certain qualified business income. So like the professional athletes that aren't on the W-2, but like the bodybuilders, the accountants, the professionals. It's a list of people that qualify. Then you get to deduct 20% of your income before calculating the taxes, and that's after you do your normal, ordinary, necessary expenses. So that's an additional tax break to you. So that's important to know about the Section 199A.
Now, question. Qualified business. What do we mean by qualified?
I'm glad you asked. So, and it's very complicated. It's not just a quick and easy. But it says the TCJA creates a new 20% qualified business deduction for pass-through entities such as S corporations, partnerships, and sole proprietors. Here are some of the most important factors. So the deduction is subject to a handful of complex restrictions. So of course they're going to make you jump through a little bit of hoops because everyone's going to try to claim this. One restriction phases out the deduction for owners for specified service businesses that have taxable income exceeding $157,500 for single filers and $315,000 for joint filers. Losses will lower your eligible income, and excess losses can be carried over to future years. Rental property owners may also benefit from the deduction, and then calculating the actual deduction can be tricky because it'll depend on many factors, including your level of income, profession, and the amount of business spends on wages and property acquired during the year. So like I said, it's not something you just really want to put in TurboTax for this year if you qualify, because if you don't qualify and you take it, then you're going to get penalized, right? If you qualify and you don't take it, the IRS is not going to send you a letter and say, hey, you could have taken this, here's your money back. No. So talk to someone that knows what they're doing, and you can talk to them about your situations, because if you don't qualify for 2018, let's talk about maybe getting you qualified for 2019, or talk about why, or talk about if it's worth it for what you want to do, what your vision, your end goal is. So I never tell anyone to, and this kind of goes into the second point, the section 162, trade or business deduction. So we talked about business deductions and said, oh, okay, you know, some people get a little free with it and say, well, everything's deductible. Okay, but just because everything is deductible doesn't necessarily mean it's good for you. So Chauncey kept saying, this is something I was going to do anyway, this is something I was going to do anyway, which is perfect. But if you weren't planning to go on a cruise and, you know, really couldn't afford it, then don't do it just because, you know, it's tax deductible. Yes. Still stick within your limits. Don't, you know, go out and, you know, try to overpress or buy, you know, a billboard when, you know, you have a small business and you just sell cookies, you know, and you can only handle 2 clients at a time. You know, so just ordinary and necessary. And then again, this is where it's important to kind of have your business model and know what you're doing. So if you have a hair salon, you know, your ordinary necessary expenses are going to be chemicals, towels, shampoo, scissors, for your license, training, you know, things like that. If you're a hairstylist, you're not going to be writing off your workout clothes, your gym membership, or something like that, versus if you were a personal trainer. So just because you talk to someone and they're a personal trainer, they say, oh yeah, I work out my workout, I write off my workouts, I write off my gym memberships, I write off my fancy little, you know, Lululemon clothes. Oh yeah, I can write that off. That's what my tax preparer said. And you're like, oh, well, I can write that off. Like, no, like, you know, the IRS is gonna wanna know, okay, when you put in that code that we'll talk about later, then that's gonna tell them what is ordinary and necessary. And if you have income and, you know, you're saying like, okay, I sell clothes and, you know, I have no inventory. They're gonna be like, what? How do you not have inventory? You know, you just make it on demand, but you still gotta have shirts. You know what I mean? You have no cost of goods sold at all. So, you know, you need to have physical. You need to know your business and explain it to defend it on an audit. And also, so we were talking about people that have multiple jobs. So if you drive Uber and you do myEcon and you do dog walking, okay, you have 3 different Schedule Cs. Don't commingle those. Keep them separate. Yeah, you may have the same clients in each. So, you know, if you're a bodybuilder and your client says, oh, you know, can you walk my dog too? Then, okay, well, you know, you kind of separate that and you say, okay, well, you can't just pay me $500 a week. Okay, well, $300 is going to this, $200 is going to this. So you need to have some kind of internal organization, and that's why I love the software that myEcon provides. Meals and entertainment expenses. So prior to 2018, entertainment expenses, if you take a client out to the Spurs game, you could write that off. Now you can't write that off. You can only write off the food. So you can still take them out to the Spurs game and discuss business and buy them a hot dog. You can write off that hot dog. You know, that overpriced $7 hot dog, you know, you get a 50% tax deduction for it. Yep. So, and any meals that you have, you know, you write down the full amount in your software. So you went out to Olive Garden, you went out to IHOP, you went out to Chick-fil-A, write those amounts, but you're only going to write off actually 50%. But I need to know the whole number when you're doing your tax return, but then the actual deduction is limited to 50%. So again, if you got a box office suite at the Spurs game because you're trying to, you know, impress a bunch of clients or something like that, you got a big fish or a big shark or a big whale, you're trying to impress, and it includes, you know, open bar and hot dogs and hors d'oeuvres and fancy finger foods, then unless you get a detailed bill, then you can't write any of that off anymore. So just kind of be careful with that meals and entertainment expenses as far as taking clients out, because the rules have changed in that area. Bonus depreciation. So again, depending on your industry, if you have assets that you're placing into business. So if you have a lawn care business and you bought, you know, a bunch of weed eaters and riding mowers and all that stuff, you don't have to take the bonus depreciation, and you may or may not want to even take it. You may want to, you know, just kind of slow down that expenses if you have losses or if you don't have a lot of income, because it may hurt you in the long run if you're just showing a big loss and you really need a loan for your next year operation because you're not cash flowing right or something like that, or something happens. So there are reasons, just because, and this again, just because something is eligible for you doesn't mean you should automatically go ahead and take it. You got to look at what you're doing. So if you have that lawn care business, you buy all this equipment, and then next year you say, oh, I quit, I'm just going to go be a bodybuilder because I like working out and I want to be in 80-degree weather, 100-degree weather in San Antonio, Texas, you know, that didn't work out for me, and you took this bonus depreciation, then next year they're going to be looking for that. You got to recapture that back, and they want their money. So there's pros and cons. So any questions that I haven't addressed so far? Any questions?
Yes, I do have a question.
Go ahead.
So when you talked about putting in the full amount of the mills, so our tax preparer is the one who will
Hey, this your guy, Mr. Chauncey Reed. Hey, just like I said, wanted to share everything with you all. Hey, from the eyes and from the mouth of an actual tax preparer, certified tax preparer. So, ladies and gentlemen, what we do, we're not, hey, doing anything illegal. We're not trying to set anybody up for any jail time or anything like that. We are just abiding by what the laws are saying that we can't abide by. So if anybody shared this with you, hey, reach out to them. Find out how you can start saving your own personal taxes, okay? We know April 15th is coming around soon, all right? So reach out to them. Tell them you want to save in taxes, all right? This your guy, Mr. Chauncey Reed. Or if you see it on my page, hit me up. Again, this your guy, Mr. Chauncey Reed. Y'all have a blessed one. Thanks for hopping on. Peace.